The other day, Jamie Dimon, the CEO of J.P. Morgan, perhaps the most important financier in the world, predicted we'd have a short, sharp, often described as V-shaped recession. That's a quick downturn followed by an equally rapid turnaround. As far as the economy is concerned, a V takes us back to where we were before the pandemic, which, by the way, was a really good place. Before Dimon's pronouncement, a V-shaped recovery was widely considered a long shot, maybe even fanciful. But overnight, it became the prevalent view. And that's the rocket fuel behind this week's incredible rally until the last hour of the session. Now, you know the mentality that produced this move, but there is one problem. I don't know if I can be completely convinced. Oh, I'd love to have a rapid V-shaped recovery. Everybody would, except for the short sellers. Be phenomenal. Unfortunately, I think the V is chimeric. At the end of the day, there's been too much carnage among the small and medium-sized service operations that do form the backbone of America's economy and job creation. Many of these companies have either been doomed by social distancing or they missed too many payrolls or debt payments because they were deemed non-essential. Will have to close their doors. They can't wait it out for the vaccine. One key part of the lockdown, most states placed a moratorium on evictions and debt collections. As we reopen the economy, though, those protections are going to go away. And if your business can't make rent, you're toast. I think the V for Victory crowd may have gotten ahead of itself. We're still in for a rough ride, even if it's not the end of the world or the Great Depression redux. So why even own stocks then? Because as I never stop reminding you, we have a new economy, one that's based on nimble technology and healthcare companies, coupled with a few winning retailers whose competitors are in tatters. They were not essential. And financial technology companies like PayPal, they're taking over the world. We're going to speak to PayPal in a moment. That's why I think you got to stick with, say, the work from home place. We just booked a Workday last night after their excellent quarter, stock 7% up. These stocks have been big winners since the bottom in March, and while many of them have fallen out of favor this week, I think that's temporary. The bottom line, it's a new market. It's a new economy. The Fed and the Treasury have learned from the mistakes of the past, which is why this market's been able to roar over the past couple of months, even as the data's been real ugly. Once that stimulus program runs out of money, I'm betting Wall Street gets less sanguine about the future. And some of these great gains, they could be throttled back by reality.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.